What's up, everybody? GenExDividendInvestor here. Chase women, not yields. I put that saying on my coffee mug for two reasons. Number one, because it irks my wife, whom I love incessantly, but apparently I also love humor, so sorry, babe. And two, to keep reminding myself not to chase yield, that sweet, sweet devil's nectar that has lured so many down a bad path, including me when I started investing. Keep that saying in mind as I analyze a subscriber's dividend portfolio that was sent to me asking for my feedback. I'm going to follow Tinder's lead and swipe right if I like the portfolio, or left if I dislike it. For those of you that are new to my channel, feel free to watch some of my other videos where I review my $1 million dividend portfolio that I've built up over 25 years of investing in the markets. And please click that thumbs up icon to help promote my videos more on YouTube. Thanks, I appreciate it. Finally, as a quick caveat, I'm not a professional wealth manager, so as always, don't take anything I say as financial advice. I'm just some random dude on the internet who is passionate about dividend investing, so just take this as entertainment. I'll run a poll on the community tab on my YouTube channel so that you can vote on if you like or dislike this portfolio. That way we can see how everyone feels about it, not just me. In my last portfolio review, I swiped the portfolio to the right, and then over 300 people in the community voted, and 79% agreed with me that they liked it. So I aligned with the majority of viewers' opinion. But now let's check out this interesting portfolio that was sent to me. Here's the email I got from a subscriber named Sal, who sent me this portfolio in April. I've gotten tons of requests to review people's portfolios, so I'm sorry I can't get to these faster. He said, "Hey buddy, I just started investing in December. I want to invest in good dividend stocks. I don't know what I'm doing wrong, but I've lost lots of money already. I just found your YouTube channel and I watch a bunch of investing channels. I'm not too good at spreadsheets, but I added my portfolio so you can see it. Thank you and God bless, Sal." Thanks, Sal. I blacked out a section of your email I didn't think you'd want me sharing. Now, Sal attached a simple spreadsheet of his portfolio in Excel, and my ask to you guys is to share your portfolios using Office 365 or Google Sheets or something other than an attachment. So first I want to say I think it's great you're investing, Sal. Also, you said you've lost a ton of money already. I'm not sure if that's accurate unless you're also saying you sold. It doesn't actually count as a loss until you sell when you're down. But I understand what I think you mean, which is that your portfolio value in April when you emailed me was lower than your portfolio value when you originally bought it in December. So I see you have 8 positions and you kept your spreadsheet super simple, so you probably are also just starting to get into spreadsheeting, so that's awesome too. Over time, I think you'll find other pieces of information that might be useful to add to it. Your spreadsheet market value is based on when you invested in December, and many of your positions have fallen a bit since then. Check out my video called How to Create a Simple Dividend Stock Portfolio Tracking Spreadsheet from Scratch Using Google, Part 1, as it's my most popular video, and it's a simple tutorial on how you can create your own tracking spreadsheet. I call that my 1.0 spreadsheet, and this week my plan is to go into a beta testing phase with my 2.0 spreadsheet product, which provides way more value than my 1.0 spreadsheet, and I can't wait to show you that. My Patreon aristocrats and kings will be getting the chance to be part of that testing team if they like, or they can just wait until it's ready for them. My plan is to give basically everything you see in my 1.0 spreadsheet, plus a bunch of new features for free, and then give my 2.0 functionality for free for anyone who remains an aristocrat or king. Okay, so your timing when you started investing was a bit unlucky, as you started investing right before things crash. So while I know that hurts right now, in the long run I wouldn't worry about that. Instead, what I'll ask you to think about is, are you investing in quality positions as a long-term investor, or are you investing for yield? Looks like you have spread your money fairly evenly across these 8 positions. I thought it might be helpful to add a bit of information to your spreadsheet for this video, so all the column headings in yellow are ones I added. I also added SPY in here, which is the S&P 500, on the bottom row for comparison, and I shaded things green if a metric went up or red if it went down. SPY basically helps you understand how the whole market is down, or at least the S&P 500 has been doing. So let's quickly go over your positions. Some of this data I got from Seeking Alpha and the Dividend channel. First you have NRZ, aka New Residential Investment Corp. They focus on investing in and managing residential mortgage assets in the United States. NRZ has fallen about 54% from where you bought it, which is harsh considering that the S&P 500 has risen about 1% during that same time. So that's some hefty underperformance by NRZ right there. Strike one. That being said, I normally like to look over longer time frames when comparing things. Their dividend was $2 per share per year when you bought, and now they've done a cut, and I think a minor increase, but their dividend is at only 40 cents per share per year. Ouch, strike 2. Their 5-year dividend CAGR is 0%, so strike 3. They have 0 consecutive years of dividend increases, so ouch again, and strike 4. But maybe they've gotten some great total returns. I chose an 11-year time frame in the total returns calculator because that was the most amount of time that covered all of your stocks in your portfolio. So if you had invested 10 grand in NRZ 11 years ago, you would now have 13.3K, which is a 4.13% annualized return. So we see that SPY's had a crazy 13% annualized return during the last 11 years, turning your 10K into 39K. Now, the normal return for the S&P 500 over the past 90 years, if you're reinvesting dividends, is 9.8%, so keep that in mind for how the overall market has been doing. So strike 5 for NRZ. We see that when you bought it, the yield was an insane 12%, which screams yield trap to me, and now with their significant dividend cut, they're at 5%. So I wonder, did you see the yield and think it looked compelling? I personally get worried when I see yields above 8% or so. Now, unfortunately, real estate has been one of the worst performing sectors over the last 5 years, with only energy doing worse. So since you're so heavy in REITs, then you've been hit hard. A quick glance at these metrics tells me they're not a dividend stock I'd dig deeper into considering, and you said you wanted good dividend stocks. If these metrics didn't look bad to me, then I would go much deeper into analysis. For a REIT, I would pull up their FFO and AFFO, their debt ratios, their growth rates, things like that. You don't use normal metrics like EPS or PE, as they aren't a great way to estimate the value of a REIT. Things like FFO and AFFO can help you gauge their ability to pay their dividend, as well as gives you some data useful when thinking about their growth options. If you watch my realty income video, then you would know it could also be helpful to understand the quality of their tenants, their history, and your confidence in ongoing rent increases, growth prospects, their churn, and their strategies for growth and such. But I'm not going to go over all that in this video. If you've watched my Tinder videos, you know that I just quickly go over people's positions and share my 2 cents on them. Watch my top stocks videos if you'd like to see a bit more analysis, or my deep analysis videos where I do about an hour of in-depth analysis. Okay, let's look at your next stock. STWD, aka Starwood Property Trust. They are a REIT, and they operate through commercial and residential lending, infrastructure lending, property, and investing and servicing agreements per Seeking Alpha. Starwood has fallen about 43% from where you bought it, so another stock with some hefty underperformance relative to SPY. Their dividend CAGR is 0%, strike 2. They have 0 consecutive years of dividend growth, strike 3. Let's look at their total returns, which will combine capital appreciation with dividends reinvested, and see if maybe that is what you were liking about it. So their total returns are 7.7% annualized, compared to SPY, which had 13% over the same time frame. My guess is that maybe you were interested in the yield on this one. It was at 7.6% when you bought, and now that the stock has been hammered down, it's at a silly 13.2%. That sets off alarm bells in my head. I wouldn't be surprised if you see a dividend cut in their future. Either way, that's an easy one for me based on their lack of performance and lack of returns. It's clearly not a solid dividend investment, nor has it been a great non-dividend investment either. Significantly underperforming SPY, both in the short term and the long term. Thus, I'll pass on STWD too. Your third stock is NHI, aka National Health Investors, a real estate investment trust specializing in retirement communities, nursing facilities, medical office buildings, and specialty hospitals. I like the space they're in. NHI has fallen about 27% from where you bought it, so another stock with underperformance relative to SPY. But I'm liking what I see in their 5-year dividend CAGR at 6.4%. That's nice. And I'm liking their 19 consecutive years of dividend growth. Let's check out their total returns. So their total returns are 13.51% annualized, which is great as it slightly outperforms the market. You got in at 5.2% yield, which has gone up to 7.5%, which is a bit high, but not insane. So I like this one with the cursory analysis I'm doing, and would now go deeper if it were me personally. But for the sake of brevity, let's move on. GPS, aka Gap, is a clothing and accessories retailer. Right off the bat, I get a bit concerned about retailers being able to remain competitive due to Amazon and such, unless they're aggressively driving into e-commerce. Full disclosure, I'm long Amazon in my non-dividend portfolio. Gap has fallen about 29% from where you bought it, so another stock with underperformance relative to SPY. They have a weak 5-year dividend CAGR at 2.44% and 0 consecutive years of dividend growth. Yuck. Let's check out their total returns. They are at 2% annualized, which is very poor and significantly underperforms the market. So why did you jump in? I'm guessing maybe it's because you saw the yield of 5.5% and you thought it looked good. Anyways, this is another one I'd pass on with just this cursory analysis. Next we come to Ford, a company which everyone should recognize. I think you meant to put F in the symbol column. Ford has fallen about 28% from where you bought it, so another stock with underperformance relative to SPY. They have a 5-year dividend CAGR, which is okay at 4.46%, and 0 consecutive years of dividend growth. No bueno. Let's check out their total returns. They actually have a nice 13% annualized return, which is nice and just slightly below SPY for this time frame. But I'm still going to pass on Ford, as I feel there are a lot more solid things out there. I hate saying that because I used to drive a Ford and loved it, but loving the car and investing in the company are two different things. Now, while they aren't a great dividend investment based on my personal criteria, some folks might explore them from a pure investing perspective. Okay, let's move on. Next we come to Glad, aka Gladstone Capital, and are a business development company that focuses on investing in loans to lower middle market businesses. A few key facts about BDCs from Investopedia are, number one, they're a type of closed-end fund that makes investments in developing and financially distressed firms, and number two, BDCs use leverage and they target smaller distressed companies, which makes them relatively high-risk investments. Glad has fallen about 29% from where you bought it, so another stock with underperformance relative to SPY. They have a 5-year dividend CAGR at 0%, along with 0 years of dividend growth, so no thank you from me. They also cut their dividend from the time you bought it, going from 84 cents per share to 78 cents per share per year. Let's check out their total returns. They have had a 9% annualized return, which is okay, but still underperforming the market. When you got in, their yield was 8.2%, and now it's at a crazy 10.7%. No thanks. Alright, let's move on. Next we come to Gain, aka Gladstone Investment, another BDC private equity fund focused on acquiring mature, lower middle market companies worth $20 to $100 million in revenue. Glad has fallen about 32% from where you bought it, so another stock with large underperformance relative to SPY. They have a 5-year dividend CAGR at a weak 3.27%, along with 10 years of dividend growth, which is decent. But one thing I do like is that they've raised their dividend from 81 cents per share to 84 cents per share. Let's check out their total returns. They have a 16.5% annualized, which is outperforming SPY for this time frame, so that's great. You got in at a 5.5% yield, and now they're at 8.3%. So at first blush, while I feel there are better dividend investments out there, this one has some redeeming qualities. Let's move on to your last one, Agnc. Agnc is a REIT that invests in residential mortgage pass-through securities and collateralized mortgage obligations for which the principal and interest payments are guaranteed by government-sponsored enterprise or by the U.S. government. Agnc has fallen about 24% from where you bought it, so another stock with underperformance relative to SPY. They have a 5-year dividend CAGR at a negative 8.66%, so that sucks, and 0 years of dividend growth, so that also sucks. So we see they cut their dividend from $1.92 to $1.44. It looks like when you got in, yield was almost 11%, so that probably drew you in. Let's check out their total returns. They have 11.5% annualized, which is good normally, but is still underperforming the market for this time frame. So this isn't a good dividend stock from my perspective. When I look at your portfolio overall, I feel that for the amount of capital you put in, your number of positions is fine. Your portfolio value is down around 23% from where you started. What is really unfortunate is that your dividend income has also fallen almost 21%. You have a lot of REITs, but I'd recommend diversifying into things like healthcare, technology, utilities, consumer staples, maybe industrials and such. Going into different sectors can sometimes help protect your portfolio a bit when certain industries are hit harder by an event, like the one we're experiencing right now. I'd also consider investing in quality over yield. Over long periods of time, quality should outshine all. Can quality companies do poorly? Sure. But a basket of quality should beat most everything else over a long period of time. What do I mean when I say quality? I mean names like Johnson & Johnson, McDonald's, Microsoft, Kimberly-Clark, and companies like that. My suggestion is to play the long game. Learn from your mistakes. You had mentioned you were watching YouTube. I've found that some channels on YouTube are better for entertainment than for their investing insights. A couple of financial channels I do recommend are Phil Town and PPC Ian's. They both have been investing for a good amount of time and have information worth listening to. In fact, my buddy Itzik just came back from a Phil Town conference, and he said it was like one of the best things he had ever attended. I'm not affiliated with him in any way, but just thought I'd mention that. So to wrap this up, in your email you said you didn't know what you were doing wrong since your portfolio has shrunk so much. Well, number one, you just got unlucky at starting investing right before there was a stock market crash. That's not doing anything wrong. Number two, had you invested in more quality companies, you wouldn't have lost so much on paper, and you would have probably bounced back faster. You also wouldn't have had so many dividend cuts, and instead could have seen dividend increases. If you don't sell, you haven't actually lost anything, so consider that as well. Now, beyond going into what I consider higher quality, I'd also recommend considering some strong non-dividend stocks like Google, Amazon, and Facebook, all of which I'm long in. So what do I think overall? I'm sorry, but this is a swipe left for me. If you want to join my free dividend Discord server, I'll offer you a couple of personal one-on-one 30-minute free private chat sessions where we can talk about your goals, your portfolio, any investing questions, really anything you want. I really want to just help you out. And my standard disclaimer, I'm not a financial advisor. I'm just someone who loves investing and has made lots of mistakes multiple times in my past, so I can relate if you feel like you made some mistakes. I think it's actually awesome to make mistakes because I've learned so much more from my mistakes than my successes. So what do you guys out on the interweb think? Vote on my community tab if you would swipe right because you would take this entire portfolio out for a date because you can 10-bag it, or swipe left if you realize that if you did take it out, you would need to triple-bag it to avoid catching anything. Of course, just because I don't like this portfolio or some of the stocks doesn't mean it or they are bad. It just means that some random idiot on YouTube doesn't like it. Thank you so much for watching all the way to the end. Leave me a comment if you did. I'd really appreciate it. These videos take a lot of time and energy for me to create, so liking my video is a simple way you can thank me. Finally, I'll leave you with this quote, though I'm not sure who said it. Stop being afraid of what could go wrong and think of what could go right. Thanks, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.